Hi everybody, this is Gary Dean with Sentiment Timing, and this is our free weekly video report for Tuesday, January 20th, 2016. Hopefully you guys, your trades have been going correctly, and with that, let's get started. So in tonight's video, I have a couple announcements I need to make, and on top of that, I'm going to go over some previous calls as well as the most recent call that's been made in the current market environment, and then go into our regular charts to see if we can get any clues as far as what is going to be taking place in this what is known now as just a very unliked market because it's been getting crushed. So the first announcement is that tomorrow we are holding a roundtable. It's going to be a little bit different than the other ones. There's going to be questions being asked to Woody. It is at Thursday, tomorrow, January 21st, 2016. Time is from 3 to 4 p.m. Eastern Time, and there is limited seating just because of the webinar structure that we use, so we could only allow so many before the seats are filled. So if you're interested, they are it's in the email that I sent you. Click and register, and you get to ask Woody some questions, and he's going to go over what he sees taking place. So at Sentiment Timing, we believe that human beings and the markets are irrational, and there's always going to be an irrational element at work, and that is what creates market opportunities. We find these opportunities through Woody Dorsey's proprietary sentiment database as well as his technical timing indicators, and we combine that with regular technical analysis with support resistance to try to come up with a setup that's going to put the odds in your favor. But, the thing is that nobody's going to be 100% correct. We don't claim to be it. We are correct a lot more than I think most people out there, because a lot of other, say, newsletters and sites, they don't really make the calls until the turn has already happened. Now, what we attempt to do, and do with great success, is predict when these turns are going to be taking place before they happen. So they're not going to be correct all the time, but what we try to do is put odds on your side. And I think the current market environment is a perfect example as far as not being 100% correct. But it doesn't really change, the odds of someone remaining short, which I'll go over in some of the other slides. So the way that we really view the market is through our market timing matrix, and it's time, and those are the reversal dates that Woody predicts, and then from there we combine them with sentiment, and that is how traders are feeling about the market, and then we you put price in that, and that is through technical analysis, bullish, bearish divergences, and support and resistance. So back in December 22nd, we were looking for weakness heading into the 5th. That got extended into the 10th. Obviously, we are in the 20th, so it has extended. And that is where what we're saying is, we're not going to be 100% correct. And a lot of it has to do with we just had extreme bearish sentiment readings. And Woody's been saying that just because they're low sentiment readings doesn't mean that it's a buy signal. Just like high sentiment readings or very bullish sentiment readings doesn't mean it's a short. They have to be interpreted, and that's what he does. But there's times that we would be expecting, like we were expecting some kind of bounce last week, and all they were just quick bounces, and then they were followed by lower lows. So does that make the shorting the markets safe? No, it doesn't make them safe. It just, right now things are, their fear is much stronger than greed, and there's a lot of fear out there. And from that, what happens is we are going to get these bounces that are going to be quick and be sold right into. So we're still the sentiment is low. Where the technical timing or reversal dates, we're looking for upside that could last into the 22nd, not that far away. Being today is the 20th. So this date may extend a little bit longer. That's why he's saying don't be anchored to them.
But in any case, the overall market environment is that the long term is a bear market. And when I say when I say long term, we're not looking at your 5-6 years like other people. Our long term is anywhere from 6, 8, 12 months. We don't really put that out, but it's the overall stronger trend is going to be down, and the intermediate term, we are also in a bear market. Now those are where you can get these big huge rallies, but it's still within a longer term bear market. And the short term bounces are just short term bounces or drops depending on what direction it's going. That's running within the intermediate. So if the trend is down and then we have an intermediate up, it shouldn't take out a particular high, and then we should get bounces or declines along the way that is running through this short-term basis. So the overall trend in our view is a bear market right now. The intermediate term is bear, and short term we are expecting some bounces, and really the sentiment will guide us through it. And if you just take a step back and think about it, I mean, for the last since 2009, I mean, everybody's been euphoric about this market. It takes a while for, after having a 6-year bull market, we're probably only in this area here as far as with the long-term part of it. But in the intermediate term, we're getting into this capitulation phase as well as the short term. So we're going to expect a bounce that's not going to take out the previous highs. That's really kind of the best way to look at things. So if we take a look at our regular charts, this is the S&P, and this is why this bounce made sense. We have support. It broke through this support. I thought this was going to hold, and it bounced. We have a nice buy signal candle, but we don't have any bullish divergences. So remember, we could get short-term. We're anticipating a bounce, and then from there, we could see another drop. Now, the next support area is looking all the way down at 1735. It may not go all the way down there, but if we do get a bounce that takes the S&P somewhere up into the 1950 area, and then it comes down and makes a low, we're probably going to get some bullish divergences on the daily chart. And then remember, that's most likely going to be switching, after we make this intermediate term low, we are expecting a nice rally that's going to last a pretty decent amount of time, but it's still going to be trading within the longer term bear market. So that would make sense if we get a nice bounce and then another low, and then that would allow for an extended rally off of that. Now, short term, I showed you this is where the support was. On the 60-minute, we still have bullish divergences in place. So the bulls need to get it through the 1900. If they do that, then don't be surprised to see them try to push anywhere between the 1950 all the way up to the 1965. And really, that is about it. If the lows are taken out, then we're probably looking for a move somewhere down into the 1780, possibly even 1730 area. But right now, it would make sense for a rally to head somewhere up into the 1950 range. So that is all I have for tonight. I'm not sure what special is being put out. We have a guy that does that, but again, it's most likely going to be for a limited amount of people, and will be extending anybody that does that subscribes will be getting a free subscription to the Markets Path publication. So if you're interested to take a look at the webinar we have tomorrow, click on the link in the email, register, and if you are interested in getting some of the market information from one of the best market timers in the world, take advantage of the special that's going to be in the email. Again, it's for a limited time and also a limited amount of people. And with that, hope to see you guys tomorrow at the webinar, and have a great night.